I am Keith McCullough, and welcome to another Real Conversation, this time on a topic that I often talk about on the macro show, which is the MOVE index, the volatility of the MOVE index, things like the yield curve. Harley Bassman, this is like your world, man, and I guess a lot of people are going to have a little bit of access to it. So thanks for joining us. I appreciate it.
Thank you.
Maybe just start with, just so people get a sense of your background and who you are, and then we'll get into your process, because it's your first time on Hedgeye TV. And again, thanks for having the conversation. I just want to make sure that people have some perspective on what it is that you're doing and where you came from.
Sure. Well, I grew up in California, used to have a Santana smile, went right to U Chicago Business School, which you can't do anymore. Ended up on Wall Street at age 23. I was at Drexel for a little bit, which was kind of interesting. Milken was not, he was there, but he was in California. We were in New York. And I ended up at Merrill Lynch in 1985, and I was there for 26 years. And while I was at Merrill Lynch, I ran the mortgage trading, option trading, and basically anything that had like a non-linear payoff, any kind of convexity products, which is what a mortgage is because they're callable, but stuff like that. Obviously, Merrill had a small problem blowing up, and I went to Credit Suisse and then to PIMCO. I was there for a few years, and now I'm kind of went off on my own, basically where I write. So you can find my stuff at convexitymaven.com. I publish, I don't know, whenever I want, maybe once a month, maybe a little less.
Yeah.
It's free. And I've recently joined Simplify Asset Management, where we've, they have some very clever ideas where they create ETFs that are long convexity, which is very different than most other places. And we've done actually something that's never been done before, which is taken ISDA products, so professional derivative products, and put them into an ETF. So civilians can access all the same stuff that the professionals can do. And that's pretty exciting.
Yeah, ISDA style options, you have to go through an arduous process. For any of you that have started your own asset management firm, when we started at Carlisle, I remember my last stop, Harley, like it was yesterday. We blew that place up nice and good. But before that, we couldn't do anything until we had our ISDA contracts in place. So that's, it's a subtle thing that you just said, but it's certainly a real thing. And having access to somebody who would typically be, just like you said, you'd be on running a desk at Merrill. That's not what your average Joe, not to say your average Joe isn't more sophisticated these days than the sophisticated Joe who thinks that they're sophisticated, but I mean, these aren't things that people have had access to in the past, correct?
No, I have a personal ISDA, which is very helpful for me, but I'll tell you that even most small hedge funds or family offices will not have an ISDA, and it's gotten more challenging after Dodd-Frank. So, but what you can do once you get into that world is rather incredible. Once you get past the 1-2 year mark where things are very liquid, and if you buy an option, it decays very quickly. You really can't go use an option as an investment vehicle. It's really more of a speculative vehicle. And Fed policy or other dynamics that are interesting, for 1 month or 3 months or 6 months, become really interesting if you go out 5 or 10 years. So in Europe, you have negative rates right now, and that will impact the stock market, the derivatives, the dividends. But if you take that negative European rate out 5 years and compound it, you get some really interesting investment opportunities.
Well, I mean, because these things on a longer term basis have these massive pops and drawdowns, and what I'm talking about is volatility. So volatility, I want to start with actually some of the slides that you gave us in preparation for this, because I do think it gives people a nice framework. Quite literally, every morning I start, when I look at cross asset class volatility, I will always highlight whether the move is moving or not. And in context, it's always moving a little bit, like to your point, but within the context of the short cycle. But the long cycle, guys, if you go to Harley's first slide here on slide 1, this is actually the history of implied vol on the move. So maybe, look at that chart. I mean, maybe just speak to it in terms of what I just said, which is there are huge peaks and valleys.
So I created the move index in, I think it was 94.
You created it?
I created it, yes.
Wow, you could have started with that instead of some of the firms, man. That's pretty cool. I didn't even know that.
Actually, the M stands for Merrill. Merrill is Merrill Option Volatility Estimate. So, which got sold recently to ICE, the stock exchange, and they didn't pay me a penny, unfortunately. But the move
You didn't get paid. You didn't get paid. You're the guy who created the move, and you didn't get paid anything for that?
Well, Merrill gave me some stock options along the way, so I can't cry about that.
Okay.
But back at the ranch, implied volatility is the significant input into options. Everything else is transparent and readily available to go look at. Implied vol is kind of the magic, and it describes the distribution around, the mean, the center of some asset, some price, whatever it might be, and it's a kind of a tricky, bothersome idea, and I wanted to find a way to market options. It was early 90s, to market the product to people and explain to them in a very simple way. And the VIX had just come out the year before, and it dawned on me, okay, fine, I'll go and create the VIX for bonds. And actually, I have more data than the VIX because we actually had data going back to 1988.
Yep.
So we could create the move going back that far. And the move's actually a very simple animal. It's a real number. It's a normal volatility, and I'll make it really simple for you. So you can explain to mom and dad at home. You take whatever the normal vol is, or in this case the move, divide it by 16, and that's how much the market's going to move, expected to move every day. So a move of 60 is more or less like we're going to move 4 basis points a day. And you can do the same thing with any kind of option out there. If gold is trading, I'll make up a number, $1,000. You would have a vol of 20. What that means is a year from now is a 68% probability, one standard deviation, that I'll be between 800 and 1,200. That's all it means. So when you look at option prices on, Amazon or AMC, for God's sakes, and you see numbers there, that kind of, you can take that option, take that, divide by 16, you get the daily price movement of what it's going to be. Right. So when you have that magic 16 in your head, it makes it very easy to go and estimate, do you think vols are too high or too low? The move index right now is around in the mid 60s. It's very deceptive. The move is actually higher than you think. And the reason why is it's made up of a blend of 1 month options on the 2-year, 5-year, 10-year, and 30-year. The Fed is basically frozen the 2-year note, and they've kind of locked in the 5-year by saying we're not going to move rates for the next year and a half, 2 years, 3 years. If you pull out the 2-year and the 5-year components of the move, then right now it would be actually in the low 80s, which kind of makes sense if you look at the chart. So I'd kind of look at that as what the move really is saying now. The Fed is artificially suppressing the front end of the curve and thus artificially suppressing the move.
Well, part of that, part of that has a lot to do with the Fed being surprised to the upside on reality, right? So the Fed moves, as you know, the short end of the curve, or moves the move because the move's got those strikes, and all of a sudden, wow, we realize it's not. Well, they haven't quite said it's not transitory. They haven't defined what transitory is, as you know, in terms of an actual duration. But they're surprised. They had to change their estimates, and all of a sudden the short end moved. So the move moved a little bit more than it had. And that, to me, is really an open question here. I wrote about that this morning, actually, just trying to walk through that. If God forbid someone like me is right, guys, slide 15 on our inflation nowcast, and inflation stays above 4 and heads toward 5 for the next 2 quarters at least, doesn't it follow, or at least it follows to me, to ask the risk management question on this, Harley, that the move should continue to move higher because the short end's finally moving?
I think, as you're describing, I'm kind of in your camp on this, but the Fed's not taking the front end up. They're going to let the back end release and move. So you will get a higher move index. So you're right about that, but you're incorrect about where it's going to come from. It's going to come from the back end moving a lot more, because the Fed's going to go, as they've said, and as they should do, is they're going to go and let the curve steepen and move QE. I actually published yesterday a commentary. I called it an open letter to the Fed, where I advised them 4 or 5 or 6 ideas that they could do at this meeting or maybe at Jackson Hole to go and modify around the edges their current policy that I think would be very helpful there'd be a public policy benefit, and one of them is to let the curve steepen.
Mm-hmm. Well, what they'd like to have happen and what will happen are often two different things. I mean, what the market to me has said to the Fed right now, hey, look, if you're going to get hawkish on the front end, then we're going to take down growth expectations on the back end. Now that can happen in two different ways. You can have deflation, or you can have economic stagflation. So those are two ways where it may not be inaccurate. It may be you get what you get, because there's always some level of probability of the curve moving in different ways, obviously relative to what the Fed would like.
Anomalously, basically since the GFC, you've seen volatility higher in the 10-year note than the 2-year note. And the previous 20, 30 years, other way around. It used to be the 2-year would lead the market up and down and would easily be 10 to 15% higher in implied vol than the 10-year note. And for the last decade, really, it's been the other way, where the back end has been much more volatile, which really it creates some weird knock-on effects that are unclearly good or bad. But that is strained. Now, what you're describing now is if the Fed does start to go and we see a 4 handle coming, it's not transitory, it's not base effect, and people get this notion they might go raise the front end, then you are right. You'll see all vols go up, and the front end was really going to go and move. Because right now, if the move index was only the front end, it'd be about 25 or 30. Mm-hmm. That's how low implied vol is in the 2-year note.
But it just started to move. That's the point. Like, we focus people on the rate of change, not the level. And after being like paint drying, it actually just moved, and it moved for the right reasons. You actually have a chart that shows this on the next chart, guys. If you show Fed funds rate versus the 5-year forward rate, you can see the pink part as opposed to paint dry. Harley, what I mean by that is that pink or purple, whatever color that line is, was dead flat on its back, not moving at all. And that's all of a sudden the Fed acknowledging that that this might not be as transitory as they thought. It wasn't too long ago, Harley. Don't forget that there are a lot of people out there, and some people that are relatively famous and should be, like Rick Reeder, who would say, "Hey, look, we'll see what happens after we get to 2%." And now they're talking about, well, due to base effects, 2 to 3 months of over 2%. It's may not be 2%. And what I'm saying, because we've had the best inflation forecast in the world for the last 3 years, both up and down, is that they're going to be wrong for longer.
I don't think anyone has actually perfected an inflation model that works all the time.
I didn't say it's perfect, but I built a great firm with that call.
You've been right. I say congratulations, but it's been very challenging to go and predict inflation for lots of people. And
that's why we do it. You got to be. That's it. You're not gonna be able to have your own house in Florida if you don't do something different, right?
That is true. That's true.
You created the move. I created a pretty damn good predictor of nowcasting inflation. We're using real-time data, using a stochastic model. Merrill, the people at Bank of America, Merrill don't even have anything remotely close to this at this point. But I digress.
Yes.
So what do you think? If I'm right, okay, because again, risk management is about, let's just say that I'm right. Let's say not a meteor hits your house right now, but I mean, let's just say that I have a high batting average on this. Let's say that I'm right. And let's say that those inflation numbers on slide 15 stick at a very high level relative to what anyone at the Fed is talking about. You don't think there'll be a lot of pin action on the front end of the curve?
No, I don't.
They don't want it?
I think that they're going to let the curve steepen on the back end. I think they're going to pull their buying forward. They'll buy fewer mortgages. They'll buy fewer tips. And steepening the curve is a public policy benefit. Mm-hmm. It helps, clearly it helps retirees. So you're transferring money from corporations who are borrowing to the boomers who are retiring soon. Helps insurance companies, helps pension funds. Those are all good things to have happen. But more importantly, what steepening of the curve will do, or not even steepening, releasing the curve to go and move by market forces, creates the ability to go and have information into the market. So historically, what you've seen is that the best predictor of a recession is the yield curve. And I wrote about this in late 2018, early 2019, saying the curve, that chart you were looking at right there, in theory, we should have a recession in 18 months. Mm-hmm. And that was my prediction. And I said at the time, I have no idea why it's going to happen because everything looks great. I guess one could say that I predicted a the pandemic, but I won't take credit for that. But lo and behold, we did have a recession in March, April, May of last year, and the curve kind of predicted it. And I think having market forces, market prices give us information so people can properly adjust their portfolios is very important. And the last time the Fed kind of got in the way of doing this, creating moral hazard, was, 05, 06, 07, when Greenspan said, we're going to use a measured pace and take rates up by 25 cents every 6 weeks. Well, if he says that and you kind of know it, then, well, what can you do? You could sell an out-of-the-money put option on interest rates, 30 basis points out of the money, because Greenspan's already told you what's going to happen. It's going to go up by 25. And you could sell a lot of those options and options on other things, because he's kind of giving you the hint. This creates moral hazard. And so was the GFC the Fed's fault? No. Were they one of the villains? Yeah, they were, because of taking away risk management tools and encouraging them to take on more risk. Right now is the same kind of idea. The Fed wants to create inflation because we have too much debt. And the only way out of too much debt is to default or inflate. And inflation is a slow motion default. Inflation is what the Fed wants. They started this 10 years ago. It's unfortunate that the inflation they got, people that say that there was no inflation, that's totally bogus. There's been huge inflation from the Fed printing money. It happened in stocks, bonds, gold, real estate, fine art, jewelry, used cars now, I guess. And so we've had massive inflation, but that's not been a public policy good. It jammed the wealth effect. It's gone and created wealth disparity, which is not good. I think the idea now is to try and use fiscal policy to create some inflation in labor, in services, in wages. That's a public policy good. But in either case, you need market forces moving prices that are driven by real supply and demand, tells people what to do. And I think a steeper curve would help people reduce their risk exposure, because it would signal to them, okay, things are potentially risky in the future. As I suspect you'll get to that eventually, because the best correlation of implied vol is shape of curve.
Mm-hmm. Yeah, that's essentially my point. Of course they'd love to steepen the curve. The last time I totally screwed this up was in 2011, when Bernanke was absolutely successful and the mother of all steepenings. I didn't think he could do it, and I was wrong. So I got a track record at least back a decade where I did screw that up that time, and it is what everybody would like. So at the end of the day, we'll have to see. In between now and the end of the day, could be two careers for me when we start to think about the. You mentioned this, and this is an important point, is what the market expects the Fed to do relative to what they actually do, or the fear of what they do and its impact on the future of the economy and the curve. So that's tough. I think we have to read. I feel like I have to read and watch on that. What do you think you need to do?
Well, there's a cognitive dissonance going on right now, where you are saying today's inflation is not transitory, it's not space effect. We're going to have it, 3 months, 6 months, 9 months from now. You might be right, you might not be, I don't know. But the yield curve is saying that we're going to have a double dip. We're going to go back into recession, right? We've flattened out 50, 60 bips in the last couple months over here. If you believe the yield curve is a predictor, the best predictor of the economy,
yeah,
the curve's saying you're dead wrong, man. We're going into recession again.
No, it's right? I take a step back on that. The curve is doing exactly what it can do when you have stagflation as a sticky expectation, or sticky stagflation. You can have 1970s style, you can have an expectation of economic stagnation where the curve flattens and they can't get it to steepen. You can absolutely have that, but you don't have to have a recession. You can have something that's very bad.
You'd get a flat curve at a much higher rate level, though.
So that's the level thing again. I don't know about the level. I know about the rate of change, which is if you do have economic stagflation, that's my point. Is that the future expectation for growth is falling, and the front end of inflation expectations remain pinned and not able to come down. That's why a curve flattens.
Why would people buy? Usually the curve flattens from the Fed jamming rates up, not because of market forces. But that said,
no, that's exactly what just happened. The curve didn't go up because the Fed acknowledged they took up their inflation forecast by the most on point-to-point rate of change basis in the history of the Fed. I mean, it's not like the Fed didn't move the front end of the curve. That's exactly what just happened.
Well, I mean, the Fed hasn't changed rates, have they?
No, you don't have to. The market, the market heard what they said. They, in your own chart, they marked up the short end of the curve as soon as the Fed changed their projection.
Nonetheless, I think that it's unclear to me that if we actually have 4% inflation as you're projecting, that people who have money would put it into a 10-year security versus a 2-year security. I'm not sure why people would lock in a negative real rate.
No, they wouldn't. What they would do in a fully allocated macro model that isn't just rates, rate centric, is that they'd buy gold. I mean, so when you have quad 3 stagflation, which is why gold did what it did in the 1970s, or did when we had stagflation into August of last year, for that matter, is that gold absolutely rips. So yeah, it competes with real yields collapsing. And yeah, if we have 4 to 5% inflation and a 1.25% 10-year yield, you have some of the you have the worst real yields in the history of real yields. I mean, it's not like there isn't an investable scenario for that.
You are right that gold and real yields are very well correlated, although I find gold to be a rather tricky animal at best. I do own gold. I like gold as a long-term asset class, diversification. So I'm on the home team with you for that.
Yeah, I just buy gold when we're in stagflation. Gold loves economic stagflation, or what we call quad 3. So that's an important one. Back to this point of inflation, you make this point on slide 7 in your deck, and this is the thing that, from a modeling perspective, if you're me front running the Fed constantly and you do have an accurate inflation model, you can use this. I mean, you're using this. You're using one of the best predictors of my model, which is the rate of change. Slide 7, guys, in his deck, which is Case-Shiller National Home Price Index. This is a monster chart. I mean, and it's leading. It's not lagging. So HPI, like we use that on slide 64 of our deck. So again, if you get the rate of change of home price inflation right, or like you said, all these things are inflating. Whether it be art or it be high-end homes or it be stocks, everything's inflating. And on a lag, inflation plays catch up to that. That's a third. Go to slide 63. A third of the CPI, as you know, Harley, is shelter. So it's really easy to get inflation higher than my nowcast, which don't include it actually going to where it's going to go. I'm front running myself on this. Do you see any? I guess to me, where I could be wrong on inflation staying sticky for longer, or sticky stagflation, however the hell I want to say it, I'd have to get that wrong. Do you think that we could see some kind of a deflationary spiral or reversal in the real estate market?
Well, as I wrote about yesterday, home prices are at the ordinary median level, not high end where guys like you live. At the median level is driven by interest rates. Nobody buys a house; they buy a 30-year payment stream. Exactly. And the median house price right now is $363, $365. If rates went from 2.5% to 3.5%. All else equal, your payment stream stays the same, the house price would drop to 320. Yep. So the issue with home prices and using them purely naked as opposed to an OER kind of thing is that it's a feedback loop where taking rates down takes housing prices up. I think if we had mortgage rates go up significantly, which they is a 1.5 significant? I guess right now it is. That would certainly take the pot off the steam right now. Home prices would certainly, I'm not sure they go down a lot, but they certainly would stop going up. Right. And that, once again, considering that the millennials are now entering into their prime years, it'd be a public policy good to raise mortgage rates to reduce home prices, or at least slow them down.
Yeah, that's it would take a lot, but the arrest of a bubble or bubbling price is one catalyst for it. We'll have to see about that. I think a lot of the deflationistas really need that though, and they need it soon. The problem with that chart, slide 63, is that the base effect, which We've got a lot of people that use those words, which is great because it's a mathematical and empirical reality you need to deal with. Is that you will not get a lack of easy comps until February of next year, where that chart bottoms at 1.5%. So that a third of CPI is going to be sticky and high for a while. Another question, on slide 3, because this is your bag, which is again, and maybe just taking a step back here and giving people the right language and the right mechanics to talk about implied vol versus the yield curve, because this is a great chart. Again, it's a very important relationship that people need to be monitoring every day. 10s, 2s against, I think you have that 1 year into the 10-year. Yeah, no, right. Yep. Can you explain that and why it really has, again, these are, and this is what you're saying, is that in your world there are huge advantage or huge alpha generating opportunities to take advantage of if you execute on a different duration when something's happening in a shorter term duration?
Well, I mean, what is implied vol really? It's looking forward, not backwards, and you're trying to go and guess what's the range of possible outcomes a year from now. And the higher the implied vol, kind of the more uncertainty you have, the more, and uncertainty is risk. So implied vol really is the price of risk, the price of insurance. It goes hand in hand. If you have a dead flat curve, so I'll make up numbers, the 2 years 3%, the 10 years 3%, then the forward rate is 3% by bond math. And so therefore, there's not much uncertainty as to what's going to happen. If you had a very steep curve, so a 2% 2-year and a 6% 10-year, then the forward rate might be 8%. Once again, using math to discount forward prices. Well, if you have a forward of 8 and the spot rate for the 10-year is 6, since we have not invented going backwards in time yet, we can only go one direction, the spot has to go from 6 to 8, or the forward has to go from 8 to 6. They've got to converge because at some day the future becomes the present. The wider that spread between today and tomorrow, the more uncertainty you have because the bigger distance you have to move to converge the two. And so the steeper the curve, or the more you get an inverted curve, you get the same effect.
Right.
The more shape to the yield curve, the bigger the difference between spot and forward, and thus implied volatility should increase because your uncertainty has increased. And that's why these two lines follow each other. And looking at this curve right now, and the flattening we've seen, there's two scenarios. Either A, the curve's going to steepen to go hit that vol number, or by the way, vols could collapse to meet the curve. It's unclear which one's which. I tend to think the curve's going to steepen, as you implicitly do because of your inflation call, but it could be if we have a flat curve and stagnation and everything else, and the Fed keeps a steady hand, you could see vols collapse again.
Mm-hmm. Yeah, well, vol really collapses like once you get into what I call quad 4 deflation, because it's a one-way trade. I mean, everybody knows what to do. The point in time that a lot of people have had wrong, I want to take what you just said and tack it on slide 20, where you show rates vol against high yield credit, because that's really, for people who only do stocks, and this is a big problem for a lot of people, and I know that they're probably implicitly or not nodding their head, Harley. They're like, these two guys are talking about shit I've never heard about, but I think I get it, or not. But they can always translate it back to stocks, right? So like when you look at stocks and high yield credit, there's certainly bedfellows there. And maybe walk through that. Like when high yield credit sniffs or high yield spreads start to break out, and this is in conjunction with rate vol, like that's a real thing to deal with. We have not had that. What's actually happened is that every time people are crying wolf about a stock market bubble, we get a correction that's buyable. High yield credit hasn't even sneezed. I mean, on spreads versus treasuries. What do you think about that?
Well, I mean, once again, you're right. Implied vol and on equities and junk bond, high yield credit moves hand in hand. In fact, Goldman Sachs has a great piece about this, looking at the relationship of like longer dated way out of the money puts versus high yield spreads. And right. I won't say it's a trade per se, but they do follow each other. But it makes sense though, because these are both assets at the bottom of the capital structure.
Yes.
But going back to the question you had about, taking people into bond land, which they always hate, although the bond market, by the way, the bond market is bigger than the stock market and has a better ability to predict the economy and the stock market does. But ignoring that small detail, in bonds, you have three risk components. You have duration, credit, convexity. Duration is when you get your money back, shape of the yield curve. Credit is if you get it back, credit spreads. And convexity is how you get it back. It's a path-dependent, asymmetric kind of risk. And you see all three of those, curve, as I've shown you with vol, goes hand in hand. The next chart, as you just showed, vol with credit spreads. They all go with each other up and down. And so you had some huge AI machine that was investing and allocating money amongst those three risk buckets, they will follow each other. As the curve flattens, people will go into credit. As the credit spreads come in, they'll sell vol options. And on the way back up, the same way. Mm-hmm. So they all go hand in hand with each other, which makes sense. Risk is risk, and they all are correlated. The problem is it's just almost impossible to actually do A versus B on a short-term basis. The leads and lags are pretty significant, and they could be many, many months between them. So that's a hard transaction. But as you describe your world with the four quads, which is a longer horizon kind of investment profile, it's very reasonable.
Mm-hmm. Yeah, the relationship between credit and rates and the cycle itself, and people's people are narrative based in the equity market like no other place, whereas in the bond market, to your point, is bigger and there are more adults and it's more glacial. And the signals, I think, are more, at least to me, they're more investable and more clear. This year has been interesting because you have so many bloody hedge funds that just can't make money, and every single month the narrative has to change because the factor exposure in the equity market that flipped changed. And it really, like I said, if you're looking at high yield OAS spread, or you're looking at a lot of different things, the CRB index, which is a pretty big signal that's not equities, which is commodities, obviously, hitting a new cycle high yesterday. They're just like chugging along.
People got to go and cover their nuts somehow. Active managers got to go and do active stuff. The issue you're circling around really is the migration of money from active to passive.
Yeah.
And which is not stopped for a decade. What are the implications for that?
Yeah.
And my partner at Simplify, Mike Green, has written extensively about how this is over time becoming more and more bothersome. We're not at a point yet where it's eaten itself, but at some point you can't have everyone being in passive. Someone's got to go and buy or sell on the margin. But you do have this core issue that as the market becomes more passive, you create a more negatively convex underlying profile, mm-hmm. which is why the firm I joined, Simplify, why I joined them basically, is they buy the optionality on both sides, the call and the put, because you could have as quick of a melt up as a melt down once you start factoring in passive flows.
Yeah, that's really what I built my entire process around. Mike and I have had one real conversation. His thoughts were super helpful because the guy's brilliant, right? I think Mike Taylor, actually a good friend of mine who's been on Hedgeye TV a bunch, he always says this about Mike Green. He's like, he's one of those guys that if you just shut up and listen, you're going to come up with all these ideas, because Mike loves coming up with his own ideas after he hears another smart individual who knows the cycle well. And I agree with that. If you look at slide 4, which is literally the first slide of my deck, this whole idea of passive flows and why it really triggers what I call the machine is paramount. It's what you should start with. You shouldn't go away from that ever again. Back when you were at Merrill, obviously the hedge funds were the blue line in that. I don't know if you can see it, but it's hedge fund AUM against ETFs and ETPs. So it's like, and now, guys like you, Simplify, people like Nancy Davis, people are coming up with, ETFs that are other parts of the market that people haven't had access to. So it's only going to get bigger and bigger and bigger. I don't think there's any way that secular trend of passive and passive flows triggering Captain Stock Picker or Captain Credit Picker, I don't think it's going to change.
Well, I wouldn't use the word ever, but in the foreseeable future, you're certainly right.
Yeah. Ever being, while I'm on the right side of the grass, at least, God willing. So it's like, it's something, that's there. Now, when you and Mike talk about this, like the idea of, convexity, what ETFs out there have that as a primary input?
Oh boy, well, I'm not sure I'm allowed to go talk about certain names of certain ETFs.
No, let's
but
just
I'll
say, don't talk about that, but more so like, my point here is that, and obviously I'm not, it's not lost on anybody that you compete with Davis, but she or you, I mean, it's relatively new to people, big time.
I would call us, we're kind of complementary in many ways. I would not say we're competitors, and Nancy is brilliant, has done a great job.
Yeah.
But we offer very different products for very different risk controls.
Yeah.
So everyone can be happy in the sandbox. But if you think about it, I think one of the key insights that we've kind of come to is there is a lot of skew in the option market for almost everything, but for stocks in particular, where the out of the money put is a much higher implied volatility than the out of the money call.
Yes.
The reason for that is multiple reasons. Stocks tend to go down faster than they go up. But the reality is that when you think about it, everybody is long equities. No one's short them. It doesn't matter who's long them. Actually, any asset, who's short? The only people who are actually short assets are the U.S. government, because they issue treasuries, corporations, because they issue stocks and bonds, and then homeowners, because they issue mortgages of sorts, right? But so it's a matter, so if someone wants to get less long, they have to go give that long to somebody else. Well, if someone's already long and you're asking them to go take on more by, selling them a put, they need a premium. They need to go and get paid for that. And then, so that's why these like a 1 month, 3 month, 6 month puts are so much higher than at the money.
Right.
And then on the call side, people like income. And so selling a 5% or 10% out of the money call option is a way to convert potential future capital gains into current income. And people who are risk averse like the idea of saying, I'd like to go and get the certainty of some more coupon, some more dividends, some more income by giving up all the upside or a lot of the upside on a stock. So you're just selling. But if you really think about it, and so therefore you'll get, like right now, if you go out, I don't know, 2-3 months, a 20-point out of the money put is about the same price as a 10-point out of the money call. That's how big the skew is right now. Let's go way out. Let's go like 5 years out, 10 years out. Mm-hmm. Think about this. If you buy an equity, what's the most you can lose? What you paid for it, right? If you short an equity, you short Amazon or Tesla or GameStop, what's the most you could lose? I won't say infinite, but a lot more. So if you go out 5 years, should the skew be the other way around? Because the put has limited loss, whereas the call, if you're short that, has unlimited loss. And the skew is backwards. And that's where you can start to go and create some really interesting profiles with that kind of insight. Yep. And on the shorter term basis, we create products where most ETFs that are involved in options do either A, you buy the asset, you buy the put, B, you buy the asset, you buy the put, and you sell the call, right? To create these target kind of profiles. Why do you want to go sell that call? The better idea is to buy the put and buy the call and own both sides of the distribution. Yeah. And that's what we've done with a lot of our products, is to add that upside call, which is incredibly inexpensive because there's this massive supply of options from people who want income. And really, who wants to buy a call? People are already long. Why do you want to get double long? They don't. So the call trades way too cheap versus its theoretical value. And when you create an ETF with that kind of profile, what you could do is, instead of buying, let's say your 60-40 is your base case. Mm-hmm. Instead of buying 60-40 like that, why don't you go and buy 55 of a profile that goes like this both ways? You have less downside because you're only long 55, right? But you have more upside because you can be a 65 on the upside because you're on the call. Yep. And that's really where it gets interesting. When you start taking these profiles, I'm not trying to convince you to buy or sell stocks. I'm trying to convince you to go and modify the profile, the path of how you get there. Mm-hmm. And this is the key component about options, which is, it's a struggle, but it's a path-dependent opportunity a path dependent, I won't call it an asset, but it alters how you get somewhere. Think about this. If you go buy IBM at 100 and it ends up at 110 a year from now, do you really care if it went to 130 or 80 before it got to 110? No, it got to 110, you made 10%. You buy a bond, same thing. You buy 100, it goes to 110, whatever, it got there. I got paid my coupon. If you buy an option, it actually matters a lot how you get to that final destination. It's a path-dependent risk. And so therefore, if you have clever people who can pick and choose interesting options and add that into your core underlying beta, right? Just asset allocation, you can improve your portfolio significantly because it's path dependent. And that's what we do.
Yeah, it's interesting because it's what people playing the game at the highest level do on both the sell side, that's where you came from, and the buy side. Hedge funds, most of my conversations on curves, shapes, because we do 50 different countries. We don't just do the US. So it's like talking about all these different curves at the same time, which can drive you nuts if you don't have consistent process to, again, aggregate your asymmetric bets if you have them. I mean, that's what, and I do think this is really it's not an adventure, the experience that is Hedgeye. It's actually revealing who's out there and who does what. Because when you and I at the beginning of this conversation are back and forth like, no, I don't agree with this, or I say I don't agree with that. That's not about the structuring the bet. That's about the direction of the bet and the expectation on the payoff. There's so many different ways to get people to a better place than a bloody 60-40 TLT SPY fund or whatever the hell it is. I mean, that's why I asked the question. I said, how many people are really out there doing this at scale? The answer is not a lot. And to your point, Nancy Davis is a pro's pro. She does a great job. And I've had a lot of good conversations with her about these types of things. And what I can find is that whether it's our institutional clients are actually, particularly family offices, if they're at that scale, they ask a lot of questions about what she does, and they'll ask more about what you do, just because people, they want to go there. They just need something to get there.
Well, I mean, what we're doing is not orthogonal to what you're doing, because all we're doing is saying, I like your idea, and here's a better way to go and execute it.
Right.
I want to circle back to something else to make sure we touch on this, that rates going up or down by itself are conceptual, and we could argue about that. But if rates go up, you can get some really nasty outcomes. And I think it's one of my slides that we might get to is there's been a correlation in the last 20 years of stocks to bonds. Stocks up, bonds down, and vice versa. They hedge each other.
That's slide 4, guys. Pop it up. It's his fourth slide.
And when you've seen the two biggest drawdowns in the last few years, in March of last year and then December 18 before that, what you had was stocks and bonds moving together down. Now, this is clearly bad for 60-40, but it's even worse for a levered portfolio, like risk parity. And the products I've created is really a way to ensure against this outcome. Now, it might be unlikely. You could be Rosenberg, you could be Lacey Hunt, who are very bullish on rates, but just fine. But what if you're wrong? What if Rosie's wrong by 5%? Small, but what if he is? That is going to be a very sad outcome, because we are a levered financial economy. And if stocks and bonds went down in unison, that'd be very bad. And we have, from that chart and the one after that, shows that if inflation gets much above 2.5, 3, and rates get much above 4, 4.5, that the correlation will flip. And that is what you should be concerned about, is not the bond prices go down because of higher rates, but if stocks and bonds go down in unison.
Yeah.
Because then all levered money is in a pickle. And I would view this as my biggest concern, is if the correlation stops going in opposite directions. And this is the red flag I'm waving right now. I'm not saying we're going to get 4 or 5% rates. I'm not saying that. I'm saying if we do get that, you should have an insurance policy or a profile that will offset that. That will be good. When you buy fire insurance, you don't hope for your house to burn down. Right?
No, you don't.
And I'm not going to go about life insurance, how you're rooting on that. So this is the idea you should have in your head is And these insurance policies are incredibly cheap right now.
Yeah.
And what's truly anomalous is, and this is some slides further down, is that traditionally we've seen the term surface, which is the surface of options from 1 month, 3 month, 1 year, 2 year, 5 year, goes uniformly up. As it should, because as you go out from 1 year to 5 years, you have more uncertainty. Everyone, I presume, is less uncertain about a 5-year future than the 1 year future. Okay? So that's the concern. What you've seen anomalously is this term surface has flattened in the last number of years. I suppose by Fed policy, but that's made, that's kind of crazy because you've actually seen more risk being introduced into the market, right? We actually have someone, you, saying we might get inflation of 4%. Right or wrong, I don't care. I'm just saying no one was predicting that before, and that is a great uncertainty whether we get a 4 handle or a 1 handle in a year. And so I find it very strange that long dated options are trading as cheap as they are, and I view that as a great worry because it signals to me people are short convexity,
yep,
short optionality, and almost every blow up we've had in the last 30 years, 40 years has short convexity somewhere, lurking at the scene.
Yeah, that's slide. Actually, they might get this. More people might understand this if you look at slide 12. He's showing SPY volatility term surface. I think on slide 12 is it? Maybe we have the 20-year volatility. The surface of 20-year is on slide 15. So
that's a good slide right there. You can see this is it's kind of crazy. Longer dated options and bonds trade for less than the short dated options, which is nutty. But that's a different story entirely. But if you go back to the prior slide, that's interesting over here. Why do you have, we're at the all-time highs and we have crazy stuff going on over here. Why would long-term vol have come down by this much relative to short-term vol? Look at that. When you look at 1, 2 years on out, it hasn't moved. Right. Why are long-dated options coming down? This is not a good thing. And the Fed is creating moral hazard by not creating uncertainty so people will go and be less risky. That vol should be higher, not lower, if people are actually being concerned about the future.
Mm-hmm. Yep. I mean, there's so many structural issues there. That's probably for another conversation. Where the hedge fund industry, with all of its leverage targeting, net targeting, their hands are constantly being forced to delta hedge, re-hedge. There's so much going on there. There's obviously massive buying by central banks, et cetera, et cetera. If you don't mind, I'm going to ask other people's questions. I have one big question I haven't asked you that I'll ask you if I don't like the questions in the queue. What is, I don't know if this is yours or not, but it's a highly ranked question. Jim's asking you to explain SVOL. What's SVOL?
SVOL. That's our new product. Yes, it's an ETF. Can I talk about that or not?
Can you? Is it new? Does it trade?
It does. It's listed.
Yeah,
it's trading.
Of course you could talk about that. The guy's asking about it. Well, actually, because he asked about it doesn't mean you could talk about it, but you could talk about it, obviously.
Okay, so in the world, we have a very steep term surface for the VIX. Mm-hmm. So the 1 month is here, and then 2, 3, 4, 5 going out. It's very steep for a lot of reasons. Because you have buyers of the 6 month option and sellers of the 1 month option, people trying to go capture short-term income. And that curve is anomalously steep. This product it existed before, I think it was XIV or whatever it was, some product that blew up 3 years ago, which was trying to capture this roll down, this slide down the term surface. We basically took that idea and said, that anomaly is still there, but it was a way too levered product. Okay. So you have a massive supply-demand disequilibrium between the 6 month point and the 1 month point, and that roll down creates carry a coupon.
Yep.
We said we like the idea. We're going to go and make it much less volatile. So we go and we buy an out-of-the-money call on the VIX, which we keep rolling over. And so basically, you're harvesting this alpha with an insurance policy. So you have a parachute on just in case things go crazy. It will yield less than the old products do. but it'll be less volatile. It'll be more stable. And our back test shows it's actually rather clever. If you get a real blow up, you actually make money because we're on the out of the money call. So it's just a way of classic, alpha arbitrage when you have large retail or institutional flows that push prices way out of line, much further out of line than they should fundamentally economically be. So there's hedge funds out there that sell 1 month options on treasuries and on equities every day at Delta Hedge, and you know who they are. And you have insurance companies who have to buy 1 year and 2 year options on SPY, SPX. They have to buy it to hedge out their variable annuities. And so we have this pressure on both sides of almost regulated people doing stuff. We're just saying, fine, we'll collect that insurance premium, but we're also going to go and limit ourselves with the call option above it.
Mm-hmm. So that's a vol premium product. It's equity. There's nothing else in there. It's not rates. Is that right?
Yeah.
Just equity.
I apologize for the noise. It's the gardener deciding to go and garden by me.
No, that's cool. All right. Here's a couple questions. So this question has to do with the flow of it all, and I've had a lot of questions on this actually. When you think about everything, actually we haven't talked about this. We've talked a lot about the mechanics, a lot about the bond math. Dave in California, what's the main driver away from all this? He's basically asking, like foreign demand for treasuries, the pension fund bid, rotation, resets. There's a lot to talk about. People talk all day long on TV.
I mean, look, I think the Fed is the key driver for all this stuff. I have advocated yesterday and for quite a while now that the Fed should reduce their buying of mortgage-backed securities, and that's one of the slides in there also.
Yep.
I use what's called the constant maturity mortgage, CMM. It's the par mortgage rate, and I compare that versus the 10-year swap rate. And this going back 10, 20 years, 30 years. I view that as the best single indicator of relative value of mortgage securities. Right now it's trading in the low 40s, 40, 41, 42.
Guys, sorry to interrupt, that's slide 6, just so that people can have a chart of what you're talking about.
The pink one. The forever average is 72, 75. The Fed is clearly distorting the market with their buying. And I would like them to go and back off and move that mortgage purchasing, go and buy treasuries, go and buy 1 to 5 year treasuries. So I'm not saying to go and stop buying. They could keep the sopping up the money if they want to. I don't like it, but I'm not going to have them change the 120, but have them stop buying mortgages because they've pushed mortgages down. And by the way, this is very important. If and when the day comes that the Fed reduces that $40 billion a month of mortgage purchases, mortgage REITs, it's going to be a big problem. That is a risk that cannot be hedged or is not hedged by the mainline mortgage REITs out there, the guys you know. There are a few out there that use mortgage servicing, MSR, mortgage servicing rights, as their hedge as opposed to treasuries and swaps and futures. Those guys will be a little safer. But the main guys, the big guys who use only swaps and futures as their hedge, that book value is going to drop like a stone. I figure about 10% if the Fed stops buying mortgage securities.
Yeah, that's and here's a follow-on question, same guy, and it just asks a different part of the market, of the treasury market. What do you think QE's effect's been on bond market vol? Is it artificially suppressed? He's asking as well.
Of course, it has been. I mean, in multiple ways. One by flattening the curve, which reduces the cost of hedging, but also just their underlying bid to the market. And clearly they produce vol. But by the way, that was a feature, not a bug. The Fed wanted to reduce volatility, to bring in money, investment money in animal spirits. I mean, the whole idea of QE was to get you out of safe treasuries and into risky assets. That was the idea, and it worked. Congratulations. But I mean, at some point, too much medicine is not healthy.
Exactly. Oh, by the way, I'm getting a lot of questions about your gold chain. That seems to be pretty popular here. And that you like gold. The way Wall Street comes full circle. When I started at Credit Suisse on the sales trading rotation program in 1999, dating myself a little bit, my boss Steve Keller, I had like I'm Roman Catholic, right? So I had my cross there, and it was a big one. It was literally the only asset I think I had, and I had it like you have it, and he's like, dude, are you kidding me? This is Wall Street. You can't have that. And now like half of the people on my floor have something that like that, maybe not gold like that. That's really cool, but it's crazy. Yeah.
This is an Egyptian cartouche. It's the coat of arms of Egyptians. So if you look at the various pyramids or other things from that era, you'll see this design. And in theory, it's my name in hieroglyphics. I can't prove that. And this is a BAHT chain, B-A-H-T. It is the currency of Thailand. And this kind of link is what they used to use for money. Hundreds of years ago.
Awesome.
So, and this is from Thailand, and this is from Egypt.
That's fantastic. This Dave California, this guy just asked 2 questions on shapes of curves. Now he's talking about how outstanding your gold chain is. All right, but the last question I have, which has nothing to do with that, and I talked to Nancy Davis about this a lot as well. I think you have a similar but probably articulated differently disdain for tips. Is that correct?
Oh yeah.
Oh yeah.
They're outright short.
Why do you guys? I mean, I don't like them either. But why do? I'll let you just speak. Like, why don't you like them?
Okay. Let's get one thing clear. Okay. Once upon a time, I'm a market maker on Wall Street, and one of my traders, customer comes in, wants to go sell a bond, and my trader won't put a price on the bond. And I said, why not? There's always a price. No bad bonds, just bad prices. Mm-hmm. Okay? Right now, tips as a product, notwithstanding my problem with CPI for all the reasons we know about, hedonics, substitution, OER, forget that nonsense. There is a price where tips make sense.
Yep.
There's a price where they don't. And right now, at a negative 1.5% real rate, which is the forever low forever, they don't make sense to me. I mean, I guess they could be. You need very high inflation to make these things viable. And if we get inflation that high, there's other trades I'd prefer to have on than this. And also at this stage of the game, I mean, I can't tell you what forget the DV01 or how much tips will move for a given move in the 10-year. I can't even tell you the direction of which way they're going to go. I see tips going down with rates up or down from the current pricing level. So it's not that I'm against tips, per se. It's the price right now it's the wrong price. And it's the wrong price, as I wrote about yesterday, because the Fed is buying more tips that are being created. When you add all the tips up, tips that are being issued, that are maturing and everything else, the Fed's buying more of them that are being produced, which I think is bad for a lot of reasons. One, just as a matter of concept, you shouldn't buy more than exists. But away from that, tips are what we all use as a way to back into the market's expectation of inflation. And expectations are more important than current reality, right? The fact that the Fed has distorted this market so much, we're getting zero information out of the tips market. That is false. And by the way, that's hurting the Fed. How is the Fed able to go and discern where market expectations are when they've distorted the primary, most visible way to look at inflation? So I think they should go, once again, slow down buying tips and go buy it in the 1 to 3 year, 1 to 5 year sector. The Fed used to own 10% of the tip market. Now they own about 25% of the tip market, which all happened in the last 18 months. That's just insanity.
It's gargantuan. I mean, prior to Dalio telling Summers to do it, there wasn't a tip market. So it's an interesting thing, isn't it, that the history of tips and where they came from, and people like you and Nancy, that you guys are creating things at this point in time in market history, right? I mean, it's like I was shocked when you said you created the move. I should have known that. Apologies for that. But there's a long history of financial products and evolution. There's a definite, like I said, until I'm on the wrong side of the grass, there's a secular path for more ETFs to replicate reality than not. And I think you did a really good job, really educating people. That's the first thing before they would ever invest in anything anyone has created, but also giving them a pretty keen sense on how to use it. So.
Let me give a plug though before the clock runs out here, is that we have created a product, I've created a product at Simplify, which is a direct drive ETF to interest rates. It's not a matter of implied or implicit, it is direct drive to interest rates, and it's a 7-year option embedded into an ETF. So you have a long time to go let this thing cook, and the decay is extraordinarily small on this ETF. And this over here is I have this on my personal account via my ISDA direct with options, and also via the securities of having this a long dated profile option that can go down maybe 10 points and up probably 80 or 90, given market moves the other way. And that's important. Now, there is a downside to this, is that it is possible that we could get your foreign change inflation and rates don't go up because the Fed holds them down. That's a great uncertainty. Will they allow that or not? I don't know. I'm in your camp about the inflation. Mm-hmm. I'm less certain about whether we're going to get the higher rates or not.
Yeah.
The Fed seems to have no worry at all about taking mortgage rates and tips to the wrong price. Maybe they feel the same way about long end treasuries.
Yeah. Well, thank you for that. And again, I think that every day you should just do like Harley's doing or I'm doing. You're resetting those expectations. The game changes, and if you're not changing alongside it, then you're going to be in trouble. So that's just a couple of, I guess, older dogs talking about reality. But thank you again for making the time.
Thank you.
All right. He's Harley. I am Keith. And we are done with our real conversation. Thank you for joining us.